Hi, everybody. It's Ted Bauman here, editor of the Bauman Daily and of the Bauman Letter. Angela Giroux is on vacation, so Clint, Lee, and I are here with Your Money Matters, which is coming out at an unusual time because it's the holiday season and people are coming and going, and our video team asked us to do it at this time. Today, we want to talk about 2021, and specifically, we've identified 5 things that we think are going to be important themes for next year and things that investors should start thinking about now. Our overall approach to 2021 is pretty much with an open mind. There's no guarantee that it'll be a better year than 2020, either economically or in the stock market, but whether it is or not depends a lot on these 5 issues that we've identified. So let's start with the first one. Clint, you've been talking to me about the role of stimulus and particularly what's been happening with the money supply. So tell us what your thoughts are, and then let's see what that means for our viewers.
Yeah, sure. I mean, we know the markets received a massive amount of monetary stimulus this year, whether you want to track that through something like the M1 or M2 money supply. We have a chart right here just showing those levels. They're indexed to 100, so how they've risen throughout this year. So, for example, with the M1 money supply, you've seen a 70% jump in those levels here alone. And as we know, the Fed's own balance sheet and central banks all around the world do all the bond buying and quantitative easing. We've really seen those levels surpass anything beyond what we could have expected, even considering the prior rounds of QE. And right now shows no sign of stopping. I mean, this is really the only way that the main way the Fed can come in and really, even try to extend support to the Main Street economy is just by keeping the capital markets kind of calm, allow rates to stay low, allow, borrowers be able to go into capital markets and to free up bank lending by at least instilling that confidence. But, as we know, there's limited ability, though, for that type of stimulus to make it to Main Street. And that's something the Fed's talked about. That's something they're aware of, and they know that these actions are they are propping up the equity markets, the stock markets, but there's kind of limited impact to Main Street. And so that's going to be a key thing to watch out for here next year, because as long as we still have COVID with us, as long as vaccines are still being rolled out, that's one thing they're going to have to do to try to support the economy. But if things start to return to normal at some point next year, and you start to see a meaningful improvement in the labor market, that's where you got to start to look out for sort of that taper tantrum. If the Fed starts to pull back on the reins and is going to start to diminish some of that QE, that's something that could be very impactful to the markets, but that's probably a second half story, not a first half story next year.
Right. So in a sense, it's like, the Fed is, or the markets, financial markets have become addicted to Fed stimulus. And, it's increasingly clear since 2008 in the financial crisis that's the case, that, basically the norm now is the expectation that that the Fed will intervene to keep markets as they are. But as you pointed out, just to go back to that chart again, let's show M1 money supply is basically the money supply that, it's the part that really goes to the broader economy and particularly into financial markets. And you can see that there's been a big jag up actually in the last couple of months here in M1 money supply. And that is the money that goes really into bond buying, which frees up money for institutions to use for whatever, whether it's lending or investing in the market. The red line, on the other hand, is, as you pointed out, that's consumer. That's the money that gets to consumers. It's just a vast difference. And people who talk about fears of inflation, thanks to money supply, I continue to maintain that they've got it absolutely wrong. The only money that goes into that M2 this year, other than through normal economic activity, came from stimulus payments. And, we know that there's a fight over how big they're going to be next year. But fundamentally, what this chart shows, I think the chart that you showed, is that stimulus follows the institutional channels that are available. And right now, the Fed can do things that the Congress can't or won't. And that's going to continue to have a big impact next year. If things go slow, I think in terms of recovery from COVID, and remember, the key for stimulus is to keep businesses alive so they don't disappear completely, because if they disappear, that's not going back to normal. That's going back to something worse than normal. The key is going to be can the Congress actually do this? Will they do it going forward for next year? But that leads to another question. And, we know that M1 money supply has been a key factor in propping up valuations this year. Is the stock market overvalued, Clint, right now?
Depends on what measure you want to look at. Yes, according to absolute levels of valuations, absolutely. But there's been some arguments recently that, considering the level of interest rates, our market's really all that overvalued. And I think that's just people are trying to use rates to justify valuations, but I think that kind of signals one of the big risks that are out there, and that's how much interest rates are playing a role in propping up valuations. And I think you've actually got a chart to talk about this on sort of the level of valuations that's coming from future expected earnings. Right.
So just to clarify, so you think Professor Schiller with his new measure is saying it's different this time?
This time is different. Yeah.
This time is
dangerous words, right?
That's right. Because what Clint's referring to is a new measure that Professor Schiller and his crew have come up with that basically compares valuations to interest rates. And he says we're not overvalued by those measures. The problem is that the market as a whole is a different animal to its components. And here's a chart I want to show you that Clint and I found this morning, actually. And what it shows is the percentage of current share price valuations that are based on future expectations, right, of growth for companies. But this particular chart shows the amount of current valuations that are based on earnings from assets that don't yet exist. In other words, companies that do not have the capital, do not have the products to produce the earnings that people are expecting them to get. And as you can see right now, we are at certainly over the last 20 years, we are at the highest level we've been for a long time. The previous biggest peak was just after the dot-com boom and bust, which is the same kind of logic, right? That you bid up the price of companies based on what you think they're going to do in the future, even if they don't currently have the capacity to produce those earnings. So what's interesting about this, I think, is that we are seeing people bet on future earnings. My argument all year really has been that you can only take that so far. At some point, even if you are betting on future earnings, you have to stop, look around and say, how much higher can we go? I mean, how much further out do we want to be? What are your thoughts on that? I mean, do you think that there's a, relative to future earnings? I mean, do you think that we are looking at the potential for maybe a bit of a rude shock? Once the herd turns, will that lead to a big pullback?
Yeah, so what I think you're talking about with that chart is sort of the whole concept of a discounted cash flow analysis, right? Which makes sense. I mean, the value of something today is the present value of all of its future expected cash flow.
Right.
The problem is when you start projecting those cash flows out into perpetuity, so to speak, there's two very important assumptions that you're making, and one is the growth rate. So, when we talk about execution risk, is the company going to be able to follow through with the growth rate that's being priced in? But then there's also
what they call that is price to perfection.
Price to perfection. Then the other thing, and this is why it's so dangerous to hang your hat on the interest rate argument, is because those future cash flows, when you're bringing them back, when you're discounting them back to the present, they are very sensitive to the level of interest rates. And so falling rates have been a huge boost to that call it terminal value component of a discount cash flow analysis. And so that's why just a small change in interest rates can have a big impact. There's a joke that the discounted cash flow analysis is like the Hubble Space Telescope, because if you change it an inch, you're in a different galaxy. And that's kind of where we are right now with rates being so low.
Right. And what's interesting also about this chart is that according to the source, the real future earnings risk, execution risk, is not in the big companies that are making money, like the Amazons and the Apples and all those. It's in the companies that have become very attractive to investors this year. Companies like Zoom, for example, they're trading at 290 times current earnings. And that means that theoretically at current earnings, you'd take 290 years to catch up to its current share price. The expectation is that a company like Zoom will grow, but Microsoft is attacking their market. Google is attacking their market. There are all kinds of companies out there providing exactly the same service. It's a very low barriers to entry market. And so in this case, what this chart is showing is that people are bidding up in the expectation that these companies will dominate their markets. Maybe they won't. There's a very good likelihood that a lot of them won't. And that means that we've got to be careful about valuations going into this year, because eventually I think people are going to say, hey, COVID is ending, at least in North America and Europe. Can these companies maintain? As soon as a chunk of investors decide they're not and start selling, it becomes a landslide. And that's the kind of thing I think investors need to look at. And that raises the third big issue, which is market breadth. There's a chart I want to flash up. Essentially what this shows is the percentage of new entrants, firms that are entering into the market for the first time to compete particularly in technology sectors and other big profitability sectors before and after quantitative easing. And what this chart is showing in a nutshell is that the flood of money into capital markets, the low interest rates that these companies have enjoyed, has allowed the biggest firms to cement their positions. It's much easier for them, at low interest rates, to accumulate big profits and reinvest those profits and become market dominant and squeeze other firms out. And so the argument here is that the Fed has actually helped to change the structure of the United States corporate markets. It's encouraged larger firms with bigger footprints, discouraged new entrants, in a sense, decreased competition. Now, question is, who gets the benefit of this when, next year when people start spending money again? How broad do you think the market's going to be? I mean, we've spoken about that a lot. It's one of your favorite measures. What are your thoughts for next year?
Yeah, I mean, you've definitely seen some broadening in stock market participation in terms of smaller cap companies outperforming larger cap ones and catching up, especially in the aftermath of the election and when we started to receive the vaccine news. But whether or not this is a sustainable trend that we'll see in the next year, right now, I would say with all the stimulus that the Fed is still providing, I think it'll be status quo, at least going into 2021. If there's socialization occurring anywhere in the markets, it's definitely in the debt markets. And by keeping that cost of capital extremely low, that's helping the big stay big, and they're getting even bigger. And it's finally starting to draw some antitrust scrutiny to certain firms that we've seen. That could be a factor. But from a capital market standpoint, with all the stimulus, I would continue to think that benefits those top names in the S&P 500. I mean, they still make up 22% of the index.
Right. But the question is, will there be stimulus? And as we were discussing earlier, the Fed has said that it's not really poised to do anymore. The Senate insisted that the Fed give up its authority to backstop capital markets. That's disappearing next year. Some really my concern, and I think the thing investors need to be wary of, is that a lot of people will continue to behave as though what has happened in the recent past will continue. So they'll keep bidding up the price of these companies because they are the market leaders and have the big profits. But then you hit that future expectations, future earnings thing that we were just discussing. How far out are you willing to bid the earnings, even of these big companies? And so the question is whether there will be a rotation away from them as people realize that they're kind of like they've reached the top of their trajectory and they're way back down. Will they begin to broaden out the market? I think they probably will, but it'll take a while for people to realize, that that's what's happening, that the big ones have got as far as they're going to go. And it's time to start looking at other companies in, particularly small caps. Now, on that score, point number 4 is what a lot of people are saying is likely to happen is a rotation back to service expenditure. And to introduce that, let's look at a chart that shows expenditure on personal consumption. That's the purple line. Again, indexed to the beginning of the year when they were all equal. The gold line is personal consumption expenditure on services. The red line is on goods. So what we've seen this year is a massive rotation away from spending money on things like restaurants, airline tickets, cruises, sporting events, concerts, all the things that you can't do when there's a virus out and about. The argument is that there'll be a rotation back towards the norm. People will stop buying as many, home goods, things like computers and office equipment to work from home, all that kind of stuff. It'll go back to services. The question is which services are likely to benefit. Morgan Stanley says there's $15 trillion worth of pent-up demand waiting to be spent on something. So what's it going to be, Clint? What do you think that are the big winners next year going to be in services?
Yeah, we were talking about this earlier. I mean, this one's really hard to pick from because we don't know right now, how the pandemic and the lockdowns, everyone's staying at home, working from home, how permanent are some of those changes in consumer behaviors and attitudes, especially in, say, the retail space, just going out and shopping, how much of that shift toward online commerce is permanent versus it's going to go back toward the brick and mortar store. So that's hard to ascertain. I mean, for me, at least, if I maybe look to my personal situation, one of the things we're looking most forward to doing is going back out to eat again. So I think you could definitely see some pent up demand going back out to the restaurants, whether it's local restaurant groups. There's publicly traded restaurant chains and conglomerates out there that you can look into. Food service companies as well that supply into the restaurant industry or
those could be big winners.
So on. Yeah, those could be some of the big winners that even I've looked at some of those stocks lately, and they are nowhere near their highs. I mean, they had been cut significantly during the pandemic. They're able to survive. Maybe thanks to the Fed keeping capital costs low and whatnot. But they are nowhere close to their prior highs. And if we start to see a reopening and some of that pent up number you mentioned, 15 trillion going back out there, that could help.
So, I mean, you talk about food service supply. I've just noticed the absence of Cisco delivery trucks just disappeared from Atlanta over the last year or so. And that's an example of that. But then there are industries like the airlines. Everybody's betting big on them. But as we discussed earlier, one of the big things about airline profits is that it tends to be concentrated in first class, business class, particularly in long haul flights. And it's quite possible that corporate executives will decide they don't need to fly to Europe for meetings anymore because they've learned how to do them on Zoom, which means we don't know. There could still be big headwinds, structural headwinds, new behaviors. But certainly for things like sporting events and cultural events and probably cruise lines and all that sort of stuff, I would expect them to bounce back big time. The key message here is that you need to be discriminating about which service sectors are going to offer the best value. We've talked about things like restaurant services, also retail real estate investment trusts, particularly the open air malls. They will probably bounce back. We've recommended them a couple of times this year, so that's another bet on that. The last point this year is China. And the reason why I think China is deserving of its own mention here is because of what's happened recently with Alibaba. And we've seen just a massive pullback in Alibaba. I want to call up a chart that shows Alibaba and Tencent. It's a 5-year chart. That drop in Alibaba's share price, the red line. And something I want to point out here is that this happened before. It happened in 2018. Both Alibaba and Tencent, the two huge Chinese internet companies, pulled back significantly during 2018 and then rebounded in 19 and then took off. And then this year they've had remarkable success. The point is here that China is one of the fastest growing markets in the world. They're going to have grown during 2020 and 2021 a projected 10%, whereas the United States will have grown precisely 0 over those 2 years. Next year, we're forecast only to make what we lost this year. So that's where the money is being made. The problem is that these companies face regulatory environment. You cannot look at Chinese companies like you would American companies. You can't just look at their technicals. You can't just look at their fundamentals. You have to understand the policy context. Right now, the Chinese Communist Party is saying nobody in this country is more powerful than the party. We will rein you in. Now, the reason I pointed out in that chart that this happened before was that's precisely what happened in 2018. The Chinese government got upset because Tencent, they were saying that they were not addressing the problem of video game addiction. That seems weird that they would concern, but basically an entire generation of Chinese youth was not, thinking in terms of what the party wanted them to think about. They were just sitting at home playing video games. And so that had a big impact on their share price. But look what happened. It bounced back. It bounced back because these companies know that they'd have to do whatever the party wants them to do, and they will do it to make money. So the reason I threw that in there is because I think it's important not to let the short-term news dictate what you do with those stocks. Having said that, my feeling is that next year, it's probably a safer option or bet to use options to play these stocks, simply because we don't know how long it's going to take. I don't think that they've reached the bottom of their decline. Clint, what do you think? I mean, you've got a great options service that has a great track record. Do you think playing options on these Chinese companies is a good idea?
Yeah, especially when you got the political risk component to it that you talked about. I mean, it's definitely different when you're looking at Chinese stocks versus domestic names. I mean, with Google and Facebook's some of their antitrust lawsuits that have come out recently from the DOJ or FTC. I know, like in Google's case, it's got to go through the legal institutions, and it's probably not going to go to trial until 2023. I mean, it's going to drag on for years versus Chinese authorities, a month ago blocked Ant's IPO and a flurry of activity since then on instructing Alibaba what to do.
Plus, U.S. companies can basically bribe members of Congress to be favorable towards it. That doesn't happen in China.
That doesn't happen, yeah. Well, yeah, and I mean, so over the last month, you've had Alibaba with a 20% plus decline in the stock price versus Google and Facebook are still right at their prior highs. Yeah, but one of the ways to play that risk component, when you got that much risk, single stock risk, one headline, one announcement can do that much damage to the share price. That's where you can look at utilizing options, because your investment in that premium to purchase that option is all you have at stake, and so that allows you to know immediately what your total dollar amount at risk is and how much you stand to lose.
Right. That's a good lesson, I think, to end the video. Your news service, Flashpoint Fortunes, has done amazing things since you launched it. I just cannot believe the track record of wins that you've achieved with that. And next year is going to go great guns. And the logic, as Clint outlined, you're not risking much when you play the options market. You're leveraging, and you have the potential for big gains. And in risky markets like Chinese stocks, that may be the way to go. So that's it from us, our last video for the year. We hope it's going to be a prosperous one. But I think the key message here is that it's going to be a year that requires careful navigation. Things are changing. And that's what we do here at the Bauman Daily. We keep an eye on those changes, and we make recommendations based on our analysis of them. So until next year, that's us signing off from Your Money Matters. Take care.
Thank you.